Okay, so in Chapter 3, we're going to focus our attention on the balance sheet and financial disclosures, and we're only doing parts A and B. So just to remind you, page 110 is where we begin the chapter, and then part B ends on page 130. So we're skipping part C. We do come back to it, but next semester we do that. So let's take a look. The balance sheet reports a financial position at a point in time. So it tells us the assets, liabilities, and shareholders' equity for a specific date. So there is Under Armour's balance sheet, and you can see there's the assets, current assets. So we further provide more details about the assets, depicting them as current, property and equipment, intangibles, and then there's other categories. Now that's a little bit more beyond the scope of what we'll be doing, some of these other long-term assets, but just to give you a flavor. There's their total assets, and then when you look to the other side, and this is in your book, I think Under Armour is, let me see. Well, Nike's there, I know that. Yeah, maybe it's just Nike that they're showing it in your book, but the current liabilities and long-term liabilities, total liabilities are reported, as well as the major components of shareholders' equity. They add them together to get your total liabilities and stockholders' equity. That will equal your total assets. Now, assets are grouped according to common characteristics. So the grouping provides information about the liquidity, the ability of a company to convert its assets to cash, and also long-term solvency, whether a company will be able to pay its long-term debts, and as well as financial flexibility, the ability of a company to alter cash flows or change them up in order to take advantage of unexpected investment opportunities or needs. So the balance sheet reporting the information about the assets and liabilities helps a decision maker determine these things. Grouping them together by common characteristics improves the ability to determine liquidity and long-term solvency of the company. There are some limitations on the balance sheet. We know we don't record assets at their market value, so that could be a limitation. Two primary reasons that we don't is because many assets are measured at their historical costs rather than their fair values. Also, there are assets that aren't even recorded on the balance sheet. They're so intangible and they're not purchased. It's just stuff the company created, like human beings. They're not represented on the balance sheet, but what a huge asset to the company in a business sense. Okay, synergy of the management and employees, how they get along, how they produce for the company. Okay, so there's certain things that are very valuable to a company that just aren't on a balance sheet. So that's another limitation. But the things that do go on the balance sheet are reported, right? And we report them as assets, liabilities, and shareholders' equity. And it comes back to our fundamental equation. Remember, assets are categorized between current and long-term. We'll look at those again. Liabilities, current and long-term, and shareholders' equity, two major parts: paid-in capital, retained earnings. So which is the following of a subclassification of assets in the balance sheet? Current assets. Ooh. Okay, let's go to it. I can't go backwards in my presentation. It'll re-record over stuff. So I think it was just another question. But now we're getting into the nitty-gritty. What is a current asset? These are our first assets that are listed on our balance sheet. They are assets that are expected to be converted to cash or used up within the coming year. What year? The date of your balance sheet. So when you're creating your financial statements, you're going to say, okay, today is December 31st, 2019. What assets will I collect or use up by December 31st, 2020? So you're going to do that every year. Okay, so things like cash, and they give some illustrations of how cash is typically used. The components of current assets are listed in decreasing order of liquidity. So the most liquid, financially liquid assets, or those that can be converted to cash the quickest, are listed first. Well, cash can't get any more like cash. Then short-term investments, because those can be sold on a market quickly within a day or two. Accounts receivable are normally the next. So you want to make sure those assets are in that order. With inventories, we usually list those next, but inventories and prepaid expenses, inventories tend to convert to cash quicker than prepaid expenses, but sometimes they're on the same playing field. So here's Nike, and this is the illustration that was in your book. Cash and cash equivalents. Now, what is a cash equivalent? A cash equivalent is a short-term investment that will be converted to cash from the date of the purchase, no longer than 3 months. So this is something you buy, and within 3 months of purchasing it, it's going to be converted to cash. It's not considered a short-term investment. It's considered a cash equivalent. So some examples of these are commercial paper, money market funds, U.S. Treasury bills that mature very quickly. So if the company has any of those, include them with cash. Then short-term investments, investments you purchase that you intend to sell quickly. Accounts receivable at net. What is that, right? That is our accounts receivable balance minus the allowance for doubtful or bad debts, minus the allowance for doubtful accounts, they'll call them, or bad debts. So the net is the difference between those two accounts. And the net is what we expect to collect, the net realizable value. And go back to Chapter 1 if you forget what that means. Inventories are then reported at what their cost is. This company has something called deferred income taxes, which you will deal with in Intermediate Accounting 3. So don't worry too much about that. Oh my gosh, I don't know what that is. Don't worry. And then prepaid expenses. And there could be some other current assets that aren't listed separately. So that's how Nike presents their classified balance sheet, the current asset section. Now again, cash and cash equivalents include cashier's checks, money orders, bank drafts, cash equivalents, and we say those are things that will mature within 3 months or less from the date of the purchase. Short-term investments in stocks and debts that you're going to sell within the next 12 months. Accounts receivable are result from the sale of goods or services. We often refer to them as trade receivables. Non-trade receivables result from loans by the company, and those are considered notes receivables. Current assets and inventories can be in one of 3 categories. Now, if you're dealing with a retailer, which for the most part that's what we'll be doing in here, you have one type of inventory, finished goods. A retailer purchases a finished good and sells it to their customer, like just about any store at the mall, right? You know, you go, I just think of the staple stores, those anchor stores, J.C. Penney's. I guess that's the only one now, right? Sears used to be there. Bon-Ton used to be at the Wyoming Valley Mall. In Scranton, there's Boscov's. All those stores are considered retailers. But there are companies also that don't just buy a finished good and sell it to their customer. They're actually making it. So they have more inventory than a normal retailer. And you'll learn more about this in another class. Managerial and cost accounting deal with this type of company, a manufacturer. But they buy raw materials. Because they're making stuff, they have to buy stuff to make the product with, and those are called raw materials. So they keep an inventory of those. Then as they take the inventory out of the supply room of these raw materials and put them into the process, they actually transfer into another inventory account called work in process. So all the costs of making the inventory is in work in process and added in there. And then when the product is finished, it transfers out of the work in process inventory and into the finished goods inventory. So some companies can have up to 3 inventory accounts. So here is Intel, because they make stuff. Raw materials, so they had $532 million in raw materials. Those are the things sitting in the supply room waiting to go into making a product. On December 26, 2015, the goods that were started and in processed, how much costs were put into them between materials and labor? $2,893,000,000. So that's the stuff that's in process of being made. That's the total cost of those items. And how much of the stuff they made that's ready to be sold? $1,742,000,000. So, and companies will present that in their balance sheet. So their total inventory, $5,167,000,000. Nice. Prepaid expenses. Remember, these are assets. When an expense is paid for in advance, you cannot call it an expense. The expense recognition principle, remember, says you can't record something as an expense. You actually receive that service. The expense occurred. Today, when we pay for something, it's a prepaid expense. We'll get the service in the future, like insurance or rent. So it sits as an asset, and if we're going to receive that service within 1 year, it's a current asset. So current assets include cash and all other assets expected to become cash or be consumed within 1 year, or one operating cycle, whichever is longer, and that was D. Usually the operating cycle is 1 year. And they give you some exceptions. When would a company have 1 year? More than 1 year. Okay, so our next category are long-term assets. These are assets expected to provide economic benefit beyond the coming year, or they won't be used up. They'll be used not only in the coming year, but beyond, or operating cycle. And there's subcategories of long-term assets. We have a subcategory called investments, property, plants, and equipment, intangible assets, and other assets. So remember, an asset will fall into one of these categories due to their characteristics. Here is an illustration of the long-term assets for, I guess this is Nike again, and they label them long-term assets and then list each major type. What are investments? Well, these are assets that are not used directly in the business, but the company owns them. So they're not using them to produce revenue. Some examples are investing in stocks or bonds of other corporations. So you just go out to the company has some extra cash, they go to the stock market, they buy another company's stock, or they buy another company's bond, and kind of hold on to it and hope it goes up in value or that they'll get some dividends or interest from it. Land, not used in the business, that's held to see if it goes up in value for speculation. The cost of that would be an investment. A long-term receivable, like a note receivable, where you loan someone money and they're not going to pay you back for more than a year. And then there's also like savings accounts, cash, set aside to do something in the future. So you're not going to use it in the coming year. It's cash set aside maybe for a project 2 years from now or 3 years. Or maybe the cash is going to be used to pay off a bond liability that the company has. These items would be grouped together in the investment section of the balance sheet. Then we have property, plant, and equipment. Remember, they're tangible, so you can touch them. That was me knocking, if you heard that. Long-lived, so they're going to last more than a year. Used in the operations of the business. So they're just not sitting around going up in value. You're using them to produce revenue. They're normally reported as a single amount in the balance sheet at what they originally cost, which would be the balance of that particular account, less the accumulated depreciation balance, the part of the cost that's been expensed so far. Traditional property, plant, and equipment are land, buildings, equipment, machinery, and furniture. Natural resources would also be categorized as property, plant, and equipment. So if the company has mineral mines or timber tracts and even oil wells, they would be listed as property, plant, and equipment, net of depreciation. The next category of assets, intangible assets. They generally represent exclusive rights, so a legal right. They're more of a legal document, right? And these are used to generate future revenue. Now, some intangible assets, if you remember back to your Accounting 111, are expensed. Now, we call the expensing of an intangible asset amortization expense. Expensing of a plant asset, property, plant, and equipment, is called depreciation expense. But you're expensing the cost of the asset. Just depending on the type, it'll have a different adjective to describe the expense. We always report these net of any amortization. Examples include any patents, copyrights, trademarks, and franchises the company purchased and owns. So if the company has these items on their books within their accounting system, they will report them on the balance sheet in the intangible area. Remember, a patent protects an invention, so the company who owns the patent can use that invention to make revenue. Copyrights protect artistic creations, so the owner of the copyright profits from the artistic creation. And trademarks protect a symbol or a slogan or a symbol. Did I say that already? I think so. And when the company owns those, they can only profit from them, as well as a franchise. If a company buys the right to use another company's name and their whole line of business, like McDonald's, when the company pays for that franchise, it's considered an intangible asset. We'll be going through these again during this semester. Then there's the catch-all category. Well, I have an asset here and it doesn't fit any of those other categories. Where do I put it? Other. A typical example of an other long-term asset would be a prepaid expense that is beyond 1 year. So the services will not only be received in the coming year, but beyond. So those are our assets. Let's take a look. Which of the following is most likely to be reported as a long-term asset? Buildings. And we know that. That's property, plant, and equipment. All the rest are current assets. Which of the following represents tangible, long-lived assets used in the operation of the business? And the answer is C. Property, plant, and equipment. Current assets are assets that will be used in the coming year or operating cycle. Investments are assets that we own but do not use in operations. Intangible assets are just that, intangible. You cannot see them. They have no physical substance. They usually represent a legal right. They are purchased and used to produce revenue. So that's the asset section of our classified balance sheet. Now we're going to take a look at our liabilities, what the company owes. Here's Nike's, their current liabilities. And you could see most liabilities are current, usually are, right? These are liabilities that are due within the coming year. So they're going to be paid within the coming year. What coming year? From the date of the balance sheet. Long-term then are liabilities that are owed beyond the coming year. So let's take a look. Obligations that are expected to be satisfied through the use of current assets or the creation of other current liabilities. They're expected to be satisfied within 1 year or their operating cycle, whichever is longer. So accounts payable, short-term notes payable, unearned or deferred revenues, accrued liabilities, and the currently maturing portion of long-term debt. Let's take a look at these in more detail. Remember what an accounts payable is. It's your obligation to your suppliers of merchandise or services you purchased on account or credit. And these are usually payable within 30 to 60 days. So they're very short term. No interest is being charged on them. You just pay back your supplier. Notes payable, however, are written promises to pay cash at some point in the future and usually have an interest charged. Even though they will be paid within 1 year, the debtor, us, will have to pay back what we borrowed plus some amount of interest. Deferred or unearned revenues, remember, they represent cash that we received from a customer before we even did anything for them. So we're going to be providing that service in the future. An example of this is when a customer purchases a gift card. All they did was give us money in order to buy something later. We didn't do anything for them. So as of the day they purchased the gift card amount will be credited to deferred or unearned revenues. Accrued liabilities. These are obligations created when expenses have been incurred but will not be paid until another reporting period. And these are usually created during the adjusting journal entry process. Things like accrued salaries payable, interest payable, and taxes payable. And your author likes to use the word accrued in front of all those, but it really isn't necessary. Just as long as you identify it as being a liability, it's created because the expense occurred, but you didn't pay for it yet. Current maturities of long-term debt. When you have a long-term loan, so normally it's not going to be paid off until a time period beyond 1 year. Maybe during the current year, you will be paying some of it off. If any portion of the principal of your long-term notes payable, bonds payable, loans is going to be paid off within the coming year, that portion of your long-term loan is considered current because it meets the definition of a current liability. So here's an example. A $1 million note payable requiring $100,000 in principal payments to be made in each of the next 10 years. So we don't do a journal entry or anything reclassifying any of the amounts out of the notes payable account. But when we're doing the balance sheet, we go, how much of that 1 million do we have to pay off in the coming year? 100,000. Well, that much of it is considered a current liability. The remaining 900,000 is considered long-term. Take a look. I thought it would be there, but it's not. If you look on page 118 of your book, again, there's the current liability section of, this might be Nike, yep. And it says current liabilities, current portion of long-term debt. So of all their long-term debt, they're going to be paying off $6 million of it in the coming year. Long-term liabilities is your other category. These are obligations that will not be satisfied in the next year or operating cycle, but beyond. And you're not going to use current assets or create more current liabilities to pay them. Okay, so we categorize these as long-term. They could be notes, bonds, something called a pension obligation, which you'll learn about in Intermediate Accounting 3, as well as lease obligations. Intermediate Accounting 3. So the key distinction between current liabilities and a long-term liability is the length of time until the obligation is expected to be satisfied. Oh, that went into 2 pages. All right, so we went through assets and all the different categories, current assets, then we have long-term assets, subcategories of investments, property, plant, and equipment, intangible assets and other long-term assets. Then we looked at liabilities, just 2 categories, current and long-term. Now shareholders' equity, which are 2 major sections as well. Paid-in capital and retained earnings. Also included, if there is for the company, accumulated other comprehensive income, or AOCI. So here is Nike's. So they had common stock and additional paid-in capital. That is their paid-in capital section. Then retained earnings, and they have AOCI, accumulated other comprehensive income. Remember, these are items that are not included on the income statement, but change equity. And they aren't from the owner. You know, there's not money coming from the owner or being taken out from the owner. Whoa, okay, I didn't expect that so quick. I'm going to flip back to, so we understand, paid-in capital. Page 119 to 120. So when it comes to paid-in capital, what is this? This is the amount the shareholder gives to the company when a share of stock is first sold. You have to remember something. When you have a corporation, they sell stock, right? So the corporation takes stock out of the safe at the corporation and says, I want to sell this stock to a stockholder. So, I mean, it's a little bit more complex than that, but let's just say that's how it happens. And they take it and they sell you a share of stock for $100. You get a share of stock, the company gets $100. Well, the first time the company sells a share of stock, that is when they are involved in the transaction. That's when they're getting money. They will increase their paid-in capital area for the amount of money they receive. And there's different accounts that make up paid-in capital. Normally, common stock and additional paid-in capital are your 2 key accounts. Now, once you have that stock, now it's yours. You could sell it to whoever you want. So let's say you sell it to your friend, Joe. Well, what does the corporation do when you sell that to Joe? Nothing. That's a transaction between you and Joe. The company is not involved in that financially. The only time they are involved in that and will make a journal entry is when they sell you the stock and you give them the cash. Retained earnings is where we keep track of the amount of earnings retained in the business, kept in the business. So remember, net income and net loss are closed to retained earnings. So retained earnings will increase for net income, decrease for net loss. And any dividends that are taken out of the company by the owners decrease retained earnings. The final part, accumulated other comprehensive income, again, are the changes in stockholders' equity other than transactions with owners. So no, it has nothing to do with the owner putting money into the business or taking it out. And other transactions that don't affect net income. And the classic one we talked about back in chapter 1, I believe, or 2, is when you have an investment in a bond that's an available for sale category. The artificial gain or loss, because you have to report that at its fair value at the end of the year. The unrealized gain or loss, the artificial loss or gain, is reported as other comprehensive income. That is the common example of what would appear in that area. So that wraps up our United States balance sheet. The International Financial Reporting Standards balance sheet, there's some differences, and we just want to bring them to your attention. International standards specify a minimum list of items to be presented in the balance sheet. Okay, so you need a minimum list, where United States GAAP doesn't do that. International Accounting Standard 1 changed the title of the balance sheet to the Statement of Financial Positions. Sometimes U.S. companies will use this title as well. It's allowed. Balance sheets under IFRS often report non-current items first and then current, where we do the opposite. So you want to keep those differences in mind. It's good to know. And there's an illustration of this on the bottom of page 120. So which of the following is true regarding GAAP and IFRS? There are more differences than similarities. And the answer was C. I can't go back, but you could take a look at that. There are more similarities than differences. Part B of Chapter 3 now talks about disclosures that are required in your financial statements. So we focused on the balance sheet, financial statement, and now the financial disclosures. So at the end of each fiscal year, companies will, with public securities, so they're traded on a stock exchange, are required to provide shareholders with what's called an annual report. And you could go to any company's website and find their annual report if they're traded on a stock exchange. So the classic one I go to is Starbucks, but you could go to Nike. You go to Starbucks website. Usually you have to scroll all the way down to the bottom of their page and look at the small print. And you'll find maybe an about the company area, or it'll say investor relations. And then you click in that area and you'll start seeing, oh, it'll lead you to the financial statement. So if anybody has any questions or you're trying to find a specific company's annual report, jet me an email if you can't find it. I'll help you do it. The annual report includes financial statements. So you get the 4 financial statements and almost the 5th if you have a comprehensive income statement as well. But it also includes additional disclosures. These kind of things are relating to the business conditions. What kind of risk factors the company has? What kind of legal proceedings are they involved with? How does their stock perform? And what are their internal control procedures? What kind of procedures do they have in place to protect the assets of the company and make sure the accounting is right? So here's some common disclosures. They explain data presented in financial statements themselves or provide information not directly related to any specific item. So you want to talk about your pension plans, leases. Now those 2 items you won't learn about until you're in Intermediate 3. But long-term debt, we're required to give a lot of information about our loans, our bonds, things like how much we owe, interest rates, collateral, a 5-year repayment plan. So what are we expected to pay over the next 5 years? So in a disclosure note, you're going to see a lot of that stuff. Investments. We're going to give detailed information about our investments, what we own, what they cost, what their fair value is, how we figured out any unrealized gain or loss on them, how we computed income taxes, our employee benefit plan, how we came up with the amount for property, plant, and equipment, how we depreciate them. So there's a lot of information we must provide beyond the 4 or 5 financial statements. We must include in our first note to the financial statements what's called a significant summary of significant accounting policies. And on page 123 is an example of one for Starbucks. Not that I drink Starbucks, I just like looking at their financial statement. But here's an example. They describe their accounting policies, subsequent events, so events that happen after the year end, but before the official annual report is put out. Public companies must have their financial statements audited. Auditors aren't sitting in a company at December 31st going, got to get the audit done, got to get the audit done. No, there's usually a lot of work involved. So it may take 2 months before their financial statement is released to the public. So we're talking about the time period from December 31st to the day the financial report is actually made public. If there's a material event that happens during that time period, we must report it as a subsequent event. And if we have any special transactions with related parties, our major customers is your brother, or a company that we own a lot of stock in. We want to tell people about that. So you could read through the summary of accounting policies here for Starbucks. Okay, so I explained that. Noteworthy events and transactions. Some transactions and events occur only occasionally, but are potentially important to evaluating a company's financial statements. Related parties transactions are one such transaction. I just told you about them. They're between the company and owners, management, families of owners, etc. So we want to know about significant related party transactions. Were there errors and fraud, misstatements that are unintentional or intentional that have been found? And any kind of illegal acts brought up against, the company or, major employees within the company, bribery, kickbacks, illegal contributions to political candidates, or any other violation of the law. The more frequent of all of those, though, is usually related party transactions. They occur a lot, and so we want to make sure we disclose those so people know we're not trying to hide anything. So which of the following would be commonly reported in the summary of significant accounting policies? Actually, B, the methods used to record depreciation. The other three would all have their own note that's separate. Okay, and that's what this basically is saying. Another part of the annual report is called Management's Discussion and Analysis and Responsibilities. They provide management's views on significant events, trends, and uncertainties pertaining to the company's operations, liquidity, and capital resources. These are opinions from management. They're part of the annual report, but they're not audited and they aren't considered 100% fact. They may be, but you have to take them all with a grain of salt because it's management's discussion, how they perceive operations, liquidity, and capital resources. It asserts the responsibility of management for the company's annual report and internal control procedures also, and it requires corporate executives to personally certify, so the CEO and the CFO, Chief Executive Officer and Chief Financial Officer in Management Responsibility section must personally certify the financial statements are accurate as SOX, Sarbanes-Oxley Act of 2002 requires. If there's found to be fraud that the CEO or CFO, it doesn't matter if they knew, if they certified that there isn't any funny stuff happening that could really hurt the financial statements, trust me, they know if there is. They could go to jail for a long time and pay hefty fines, up to 20 years in jail. Okay, so you could see these as part of the annual report. Now, Nike's is on page 127. Also a part of the annual report, the SEC requires companies to provide information about the compensation of their directors, so the board of directors, and their top executives. A proxy statement must be reported each year to all shareholders, usually along with the annual report. Statement invites shareholders to the annual meeting, to elect board members, and to vote on issues or to vote by proxy. You allow someone else to vote in your place. Included in this proxy statement is the reporting of compensation and stock option information for directors and top executives. Now, what is that? Stock options give the executive the option of buying stock of the company at a reduced rate. You're like, well, they still got to buy something. I remember learning this going, well, you still got to buy it. Let's say you're an executive and your stock option package gives you the right to buy 10,000 shares of the company stock at $30 a share. Oh, what's that? $300,000. If you do that, when the stock is trading for $100 per share, you could immediately sell that 10,000 shares and bring in $1 million. So your compensation is the difference, $700,000. You had to pay $300,000, but you were able to get $1 million. Not bad. So executives like to have that option, stock option. They need to be reported. So where is management's discussion and analysis located? Management's discussion and analysis is presented in the company's annual 10-K filing with the SEC. It will precede the consolidated financial statements and audit report. So it's part of the annual report. Another part of the annual report is the auditor's report. And this is required. A public company cannot just put financial statements on the internet and go, there's our financial statements. No, in accordance with SEC guidelines, they must be audited by an independent certified public accountant. Now, there are 4 large accounting firms in the world: KPMG, PricewaterhouseCoopers, Ernst & Young, and Deloitte. And they are usually the ones, one of those will be auditing a large public company. Only certified public accountants can sign off on an audit of financial statements. And not only do they audit the financial statements, the numbers there, but they also audit the procedures the companies have in place to protect the assets. And they attest. Not that there's fraud. They don't look for fraud. They don't look at every single transaction of the company to make sure it's perfectly recorded. They actually sample, and it's meant to attest or to say, hey, these financial statements are fair. So they're not attesting to perfectness, they're attesting to fairness. And they'll report this result in the auditor's report. Now there's 4 different opinions that an auditor has to choose from as a result of the findings in their audit. The first is an unqualified, and it doesn't sound like it, but that's the best one you can get. It's not qualified. It means I can attest that these are fair. Another one is an unqualified, so everything's pretty fair except for this one little thing, and they give an explanatory paragraph. So those are, you want that 1 or 2. A qualified report is, sorry, we can't. And these are explained on page 130. Qualified opinion is either the audit process has been limited, so the company wouldn't let the auditors look at stuff, or there was a huge departure from GAAP. Neither is sufficiently serious enough to invalidate the financial statements as a whole. So it's not good, but it's not the worst. An adverse or disclaimer, adverse is this is bad. So specifically, when the auditor has specific knowledge that financial statements or disclosures are seriously misstated or misleading, they're very rare. People usually withdraw from the audit for an adverse opinion. And a disclaimer is when the auditor is not able to gather enough information to even make an opinion. So as a company, we want 1 or 2, right? And we work with the auditors to get 1 or 2. If there's errors or problems, we do our best to rectify them and produce the financial statement the auditors feel is fair. So again, an unqualified report is what we call a clean report. The auditor has undertaken professional care to ensure that the financial statements are in accordance with GAAP. They have planned the audit accordingly. They understand how the company operates. They understand its procedures, and they gather evidence to attest to the accuracy of the amounts in the financial statements. Not perfectness, but fairness. Circumstances where the auditor believes the financial statements are in conformity with GAAP, but other important information needs to be emphasized so that people understand there might be a little issue, like maybe there's a lack of consistency, or maybe it doesn't look like this company is going to continue to operate in the future. We need to make sure you understand this matter that's happening here. And then our other auditor reports. Okay, and we talked about these. So which disclosure provides an independent and professional opinion about the fairness of the representation of the financial statements and about the effectiveness of internal controls? Auditor report. Okay, so that is our annual report. So our first section focused on creating the balance sheet, the different sections of the balance sheet, and then our second section focused on the whole annual report, the different parts of it. So it's beyond 4 or 5 financial statements. We have disclosure notes, which we have to report important information, not only about the financial statements, but other items within our company that may influence a decision maker's mind. Management's discussion and analysis is presented. Management provides their responsibility and signs off on it. The proxy letter with the compensation of directors and top executives, and definitely the auditor's report. Okay, so that ends our discussion of Chapter 3, Parts A and B. Please post any questions to the discussion board.